different types of insurance. By the end of this presentation, you should be able to identify the features of the different types of insurance products available. You should be able to assess the advantages and drawbacks of different types of insurance products. And lastly, you should be able to evaluate the suitability of different types of insurance products, again showing consideration to the needs of the user. Let's start by looking at one of the more common insurance packages that you've probably seen out on the market, and that's car insurance. Car insurance is a package in which an organisation provides protection against possible eventuality. And in this case, it's a situation related to issues around your vehicle you drive and your motor and your car. Car insurance typically works by the customer paying the insurance company a policy to cover them against the risk of injury or damage that they may be caused to them or may cause to somebody else when they're out driving. Now, the premium, and that's the amount you pay to the insurance company, is calculated based on purely the level of risk that the customer is going to place on the insurance company. And it tends to be based on the age of your car, the power of your car, and your driving habits at the time and day that you drive. Also the locations where you drive or where you live, because obviously if you're in a location that's got a higher rate of risk for say theft, for example, then that's going to cost you more to buy, because they're going to see that as a greater risk to them. And also the level of experience you've got as a driver, because the more experienced you are, in theory, means that you should have a lower chance of having an accident and a lower level of risk. Now, there are different types of insurance packages that tend to be available. You have things like third party, which only covers somebody else. So if you have an accident, you can cover the damage you cause to their vehicle, but not yours. Or you can have what's called fully comprehensive, where you cover everything. That's yourself and other people involved, or the third party involved. You can also have packages, for example, where you can protect your no claims bonus. So that means that as a result of that, if you do make a claim, then maybe in the first year of your claim, you might get a protected no claims bonus, so you can make that claim next year with full no claims. These are all financial packages that are sold on the proviso that effectively you can increase the amount you're going to pay to the insurance company, but you are then lowering your own risk and increasing the risk to them, so you're going to pay for that privilege. You also have home and contents insurance. Now, home insurance is a package in which the organisation provides protection against possible eventuality. This time, of course, they're all linked to the home, so every situation linked to the home. Now, home insurance works by the customer paying an insurance company policy, effectively to cover them against the risk of damage to their home. And it typically covers the cost. Effectively, that policy is worked out on how much it will cost to effectively put your home right if it was damaged. And they actually look at effectively the idea of the cost to rebuild your home. So that's where they work it out from. So in the worst case scenario, if they had to build your home from scratch, how much would it cost? And then they'll work out that premium and factor in that level of risk. Now, content insurance is also a package that sometimes comes along with home insurance, or it can be a separate package. And that actually covers the cost of all the contents inside the home. And that can be from things such as against theft or unexpected events. So it could be again from a fire, for example. So maybe if you had home insurance, it would cost the rebuilding of your home from a fire. Or if you've got home and content insurance, it also cover the cost of replacing the items that have been damaged in the fire inside the house. Now, the premium again is calculated based mostly on the maximum cost of any such claim, so the value of your house and your content insurance. But it's also based on the level of risk again, so how many claims you made in the past. So they're going to factor all those issues into there before they're going to allow you to take out that premium. Another type of insurance that's sold is something called life insurance. Now, life insurance is a package in which an organisation provides protection against a possible eventuality, and of course this time the situations tend to be related to your life. Now, life insurance works by the customer paying an insurance company a policy premium to cover them against the risk effectively of death. Now, the idea here is that should you die, then any debts that maybe you have will be settled by the insurance payment, as well as potentially a lump sum being paid to chosen beneficiaries. This premium tends to be calculated mostly on the typical health that you've got, so how healthy are you, and the age of the person who's looking to take out the insurance package. Clearly, if you're younger and of better health, then you're going to pay less, but you're going to pay it over a longer period of time than somebody who's older and maybe of poor health. And that's because insurance companies are effectively just like a business, and they're trying to make as much profit as possible. So they want to effectively take on somebody who's low risk. High risk means that there's a good chance that they're going to have to pay out. So again, insurance policy is just purely about managing that risk. You also have travel insurance, and that's a package which an organisation provides to protect against an eventuality such as anything related to travel. Now, travel insurance works by the customer paying an insurance company effectively a policy to cover them against any travel-related issues. It could be medical insurance, for example, because not all parts of the world have free medical care. It could be against trip cancellation. So if your trip gets cancelled at the last minute, like for example if a volcano erupts, it could be lost luggage, or it could be very flight delays that cause some form of issue or some sort of financial loss. And that's what it comes down to. Insurance is trying to protect you against financial loss. Now, the premium is, again, calculated mainly on where you're going to travel to, so the level of risk. And again, it could be from your own experience of travelling. So if you've made lots of claims in the past, then there's a good chance they will charge you more because, again, as a business, they're trying to reduce the amount they're paying out and the level that it's going to cost them as a business. Now, there is another type of insurance that some people take out, and this is called pet insurance. Now, pet insurance tends to be a package that tends to protect you against any eventuality linked to animals that you may own or in your household. Now, pet insurance works by the customer paying an insurance company a policy to effectively cover their pet against any such issue, such as maybe veterinary bills, the costs incurred when you maybe have to try and find a lost pet, or it could be any costs that are incurred maybe from any injury that a pet causes to somebody else. Now, these are all costs and different packages that probably depends on what you take out, because each insurance company will offer different types of pet insurance. You can rest assured that the cheapest type of pet insurance won't cover anywhere near the level of coverage at what one of the more expensive packages of pet insurance will cover. Now, the premium again tends to be located on the type of pet you have. So again, what's the risk of that pet getting ill or injured? And again, the age of the pet and where you live. And of course, it also depends on what you want covering. So the more that you want covering, the more that you're going to pay in pet insurance. But again, it's a way of protecting you against financial loss should your pet ever become ill. Some people choose to take out something called health insurance. Now, health insurance is a package in which an organisation is effectively protecting you against anything to do with your financial health, so your own health overall. Now, that's because sometimes the NHS won't cover every operation, or you have to wait a while for the NHS to operate. So maybe you want to take out what's called private medical insurance, where you can effectively get this operation carried out privately, which might mean it gets done a lot quicker, and as a result of that, you might get better care, because they might use more modern methods of treatment, for example, which the NHS doesn't deem to be financially viable. Now, health insurance works by the customer paying an insurance company a policy to cover against their health-related issues. And this could be your medical bills, or it could be the ability to seek private treatment. So think about the first part. It's effectively saying that you can go private, you can run up a bill, and we'll pay the bill. Well, the second one is suggesting that actually you can get private medical treatment, and we'll pick up all the bills as we go along. Now, again, there are different types of insurance policies. Some cover private treatment, and some just cover effectively paying your costs back. That depends on your financial needs to obviously work out which package is best for you if you want to take out that package. And again, the premium is purely based on risk. It tends to be on age and your medical history. Are you likely to make a claim? If you are, then you can expect to pay more money in your insurance premiums for health insurance. So what I've done here, because insurance tends to be fairly similar and just needs to be applied to the type of insurance that you take out, I've tried to categorise some advantages and drawbacks in general that you can then apply to each type of insurance. So the advantages tend to be that it provides protection against risk and financial loss, and some people take out their insurance for that very reason. They accept that they're going to be paying a large amount of money that they hope they never have to use, but it's that hope that they don't have to use it, but if they did have to use it, then they're obviously managing their risk and how much they potentially could lose. You actually can potentially get tax relief benefits from different types of insurance. For example, health insurance could be deductible from your wages before tax, so it could give you advantages from your wages and obviously give you benefits when you've got any illness or you need medical treatment. It also tends to provide stability and confidence. Some people really do like that support, like I said before, about the fact that insurance is there to protect you and it's always available to be able to use. And of course, insurance tends to give you access to legal expertise and provides guidance if something does happen or you're in some sort of potential problem where you need to try and manage that situation. Of course, there are drawbacks with insurance. For example, most policies actually have exclusions known as the act of God. So anything that could have been caused apparently by nature or by the idea of God in general, then it won't be covered by insurance. So for example, a lightning strike would not cover in the insurance. That does mean that if you had a fire as a result of a lightning strike, then the act of God clause would be initiated and you wouldn't get any payout. So some people would then argue that, well, what's the point of insurance for a fire when it's not covered? Like flooding, for example, some of the flooding specifically is covered under act of God unless you take out special insurance that obviously negates against that risk, but of course it's going to cost you more money. Premiums tend to be expensive and they are based on the level of risk. So if you live in an area that's deemed to be high risk or you are deemed to be a high risk, you've made more claims in the past, then you can expect to pay more in your insurance premiums. And that's all based on the fact that their businesses have got to try and make money. Also, you have to follow the exact requirements of the policy and paperwork. If you were to complete something incompletely or you were not to follow the policy that you agreed, then you could find your insurance is null and void. And then the insurance company would not pay out even though you've made payments each month thinking and believing that you're going to be covered with insurance. That's why it's really important to make sure you follow the policy, agreements and paperwork that you signed. That concludes all the advantages and drawbacks of insurance. Now you should have an idea of what advantages and drawbacks you can apply to the different financial insurance products and packages that are sold. Remember what we've looked at, most of the packages are all similar, it's just what they cover that differs. Thanks for checking out the BeeBusinessBee YouTube channel. Don't forget to click the subscribe button down below to subscribe to our YouTube channel. Don't forget to follow me on Twitter, it's at BeeBusinessBee. Also, give the Facebook page a like, it's facebook.com/BeeBusinessBee. And lastly, don't forget to check out the online hive of activities found on BeeBusinessBee.co.uk, full of quizzes, activities and resources. And remember, until next time, keep buzzing!